Debt capital market and equity capital market. Exploring the basics of capital markets and instruments. Agenda. Introduction to capital markets. Debt capital markets DCM. Mechanics of debt capital market. Equity capital market ECM. Mechanics of equity capital market. Comparing debt and equity capital markets. Definition and importance of capital markets. What are capital markets? Capital markets are platforms facilitating the trading of financial securities, enabling buyers and sellers to interact efficiently. Price establishment. These markets play a vital role in determining the prices of securities through supply and demand dynamics. Liquidity provision. Capital markets provide liquidity, allowing investors to buy and sell securities easily, which is crucial for economic health. Types of capital markets. Primary markets. Primary markets are where new securities are issued to investors, providing companies with capital for growth. Secondary markets. Secondary markets involve the trading of existing securities, allowing investors to buy and sell previously issued stocks and bonds. Role in capital allocation. Both primary and secondary markets play crucial roles in capital allocation and shaping investment strategies for investors. Role of capital markets in the economy. Mobilizing savings. Capital markets facilitates the mobilization of savings from individuals and institutions for productive investment opportunities. Price discovery platform. They provide a platform for price discovery, allowing investors to determine the value of financial assets through market interactions. Risk management. Capital markets enable effective risk management through a variety of financial instruments, helping investors hedge against uncertainties. Economic growth contribution. They play a crucial role in fostering economic growth and stability by facilitating investment and liquidity. Debt capital markets DCM. Definition of DCM. DCM or debt capital markets is the market for issuing and trading debt instruments, including bonds and notes. Financing opportunities. DCM provides entities with essential financing avenues to support their operations and grow through debt instruments. Investor opportunities. Investors benefit from DCM by accessing fixed income opportunities, which offer stability and predictable returns. Types of debt instruments. Corporate bonds. Corporate bonds are debt securities issued by companies to raise capital, typically offering higher returns but carrying higher risks. Government bonds. Government bonds are issued by national governments and are considered low-risk investments, providing fixed interest payments over time. Municipal bonds. Municipal bonds are issued by local governments or municipalities, often offering tax-free interest, making them attractive to investors. Convertible bonds. Convertible bonds are hybrid securities that can be converted into a predetermined number of the issuing company shares, offering potential upside. Advantages and disadvantages of debt financing. Tax benefits. One of the significant advantages of debt financing is the tax benefits that can arise from interest payments, which are often tax deductible. Retain ownership. Debt financing allows companies to retain ownership and control, unlike equity financing that may require giving up shares to investors. Interest payments. A significant disadvantage is the obligation to make regular interest payments, which can strain a company's cash flow. Potential default risk. The risk of default is a serious concern, especially if a company's cash flows are insufficient to meet debt obligations. Mechanics of debt capital markets, issuers and investors in DCM. Role of issuers. Issuers in DCM, such as corporations and governments, raise capital through debt issuance to fund projects and operations. Types of investors. Investors in DCM include institutional investors, mutual funds, pension funds, and individual investors seeking stable returns from debt securities. Stable returns. Investors are attracted to DCM for the stable returns offered by bonds and other debt instruments, providing predictable income. Process of issuing bonds, determining fundraising amount. The first step is to determine how much capital needs to be raised through bond issuance. Set an interest rate. Next, the issuer sets the interest rate based on market conditions and investor demand. Marketing to investors. The bonds are then marketed to potential investors, often with the help of investment banks, to reach a wider audience. Rating agencies and their role. Creditworthiness assessment. Rating agencies evaluate issuers to determine their creditworthiness, influencing investor decisions and market stability. Investor risk gauging. Ratings provided by agencies help investors gauge the risk associated with various bonds, guiding their investment choices. Role in debt pricing. Rating agencies play a critical role in the pricing of debt securities, affecting market dynamics and investment strategies. Equity capital market, ECM. Equity financing market. ECM centers on the process where companies issue shares to raise capital for growth and operations. Access to funding. This market provides businesses with essential funding opportunities to support expansion and innovation. Investor ownership. ECM allows investors to acquire ownership stakes, creating a partnership between capital and business growth. Types of equity instruments. Common stocks. Common stocks represent ownership in a company and give shareholders voting rights and dividends. Preferred stocks. Preferred stocks provide shareholders with fixed dividends and priority over common stocks in asset liquidation. Convertible securities. Convertible securities can be converted into a specified number of shares of common stock, offering flexibility to investors. Advantages and disadvantages of equity financing. Raising capital. Equity financing enables companies to raise capital without taking on debt, offering more financial flexibility. Dilution of ownership. One downside is the potential dilution of ownership for existing shareholders, impacting control over the company. Potential returns. Equity financing offers investors potential capital gains and dividends, making it attractive despite the risks involved. Higher risks. Investors face higher risks with equity financing as returns are not guaranteed and depend on company performance. Mechanics of equity capital markets. Initial public offerings, IPOs. Definition of IPO. An IPO, or initial public offering, is the process by which a company sells its shares to the public for the first time. Capital raising. Through an IPO, companies can raise substantial capital to fund expansion and growth initiatives, benefiting their operations. Investor opportunities. IPOs provide investors with a chance to purchase shares and invest in potentially profitable businesses from the outset. Secondary offerings and private placements. Understanding secondary offerings. Secondary offerings allow existing shareholders to sell their shares to the public, providing liquidity and capital to the company. What are private placements? Private placements provide selling securities directly to a select group of investors, often at a discount, bypassing public markets. Strategic purposes. Both secondary offerings and private placements serve different strategic purposes for companies, such as raising capital or restructuring equity. Stock exchanges and their role. Regulated trading platform. Stock exchanges serve as the regulated environment for buying and selling shares, fostering investor confidence. Transparency and liquidity. They ensure transparency and liquidity in the trading of equity securities, allowing for efficient market operations. Impact on market dynamics. Stock exchanges significantly affect market dynamics, influencing prices and investment strategies. Key differences between DCM and ECM. Debt securities. DCM. DCM focuses on debt instruments like bonds that require repayment at maturity, impacting investor risk and returns. Equity securities, ECM. ECM deals with equity instruments like stocks, representing ownership in a company and offering potential for capital appreciation. Impact on investment strategies. The differences between DCM and ECM influence investor strategies, risk tolerance, and overall portfolio management. Investment strategies and risk profiles. Debt capital markets, DCM. Investors in DCM focus on achieving stable returns with lower risk exposure, making it a conservative investment choice. Equity capital markets, ECM. ECM investors aim for higher returns, accepting greater risk exposure, which can lead to significant gains or losses. Portfolio diversification. Understanding these risk profiles is essential for effective portfolio diversification, balancing risk and return. Choosing between debt and equity financing. Understanding DCM and ECM. Companies need to understand the differences between debt capital markets, DCM, and equity capital markets, ECM, for informed decision making. Assessing financial situation. Evaluating current financial status is crucial in deciding the best financing option to support business objectives. Impact on capital structure. The chosen financing method significantly influences the company's capital structure, affecting control and overall financial health. Conclusion. Importance of capital markets. Debt and equity capital markets play a vital role in financing business operations and fostering economic growth. Understanding mechanisms. A clear understanding of capital market mechanisms helps investors make informed and strategic decisions. Evaluating risks and advantages. Evaluating the risks and advantages associated with capital markets empowers companies to optimize their financing strategies. Thank you.